Another close here, David, another close, green all over the screen, David. So I was just talking to Lou about this. Looking ahead, we just keep kind of melting up here, David. What are your expectations?
You know, unfortunately, I think the market right now is probably getting a little bit overextended. When I look at our valuations, the market overall is trading at about a 2 to 3% premium to a composite of our fair values. You know, we cover over 700 stocks that trade on U.S. exchanges, so we compare our intrinsic valuation compared to the market capitalization. And the 2 to 3% premium may not necessarily sound like much, but when I look at our valuations going all the way back to 2010, less than 20% of the time has the market traded at this much of a premium or more. I just think the market in the short term has just gotten to be a little overly complacent, starting to see some signs of excess speculation, meme stocks starting to make a comeback, short squeezes. I actually just heard about a resurgence in SPACs. We haven't seen those for years at this point, an increase in call buying. So in my mind, still market weight overall. I think positioning is more important than ever, but I do think it's a good time to look to take profits where stocks have rebounded too far, too fast off those April lows. April 7th on the Morning Filter, which is my weekly podcast, is when I had officially moved to an overweight. So at this point, I just don't see the tailwinds to really continue to keep pushing the market that much higher here in the short term. You were talking about the E's earlier. When we look at the U.S. economic growth, our economic team expects the U.S. economy to slow sequentially, for the next 3 quarters. Of course, we have, the tariff negotiations going on. I think it's really going to be all about what China. China, of course, is not going to roll over on these negotiations. I think that's going to be hard fought. Not getting a tailwind from long-term interest rates. They're still kind of in that trading range in the mid-4s. Inflation still moderate, but again, that's going to come up later this year as the tariffs, start to hit. And for now, I think the Fed's on hold. So again, I'm not seeing those tailwinds really to get the market to continue moving up that much more. So good time to take some profit taking, but then also, as you talked about earlier, move into some of those, low valuation stocks.
Lou, what do you make of this argument? David saying, listen, looking a bit stretched here.
Yeah, I'm a bit more aggressive all-in kind of guy, but I can't argue with you. Those are definitely concerns. It's those traditional wall of worry that we have to climb. But I'd agree. Look, if you're taking profits here, I always come up with the conundrum of what do you do once you've taken the profits? So to your point, we were talking about earlier, you got to find the opportunities. Where are you buying value in this market? We've talked about, on a sector basis, energy looks really attractive. And it's the missing link to the AI growth boom. If we don't have the power to power, pun intended, the chips that are going to lead to productivity gains for AI, we really can't move without that. So you need to see energy pick up at some point. But again, I'd be curious, David, in your universe of coverage here, as you tell people to take profits, you had a great call on and getting in. Where do you see value in this market? Is it small caps? Is it certain sectors that are interesting to you? Is it an asset class?
It really just depends on the type of investor you are. I mean, looking at positioning, we like value stocks. Value stocks still trading at about a 6% discount overall to our fair values, but growth stocks getting very overextended. They're trading at a composite of 15% premium. The last time they were trading at that much of a premium was beginning of this year when we had also thought that they were overextended. That was, of course, before DeepSeek, hit the headlines, forcing all those AI stocks, to start selling off. The only other time growth stocks were at a higher premium was at the very beginning of 2022, back when we were actually underweight equities going into that year and, of course, had the market sell off. And we do still like small caps. Small caps overall trading at a 16% discount to fair value. I would just caution investors, small caps is going to be much more of a longer-term investment than a trade. Historically, small caps will do well when the economy has already slowed or maybe even gone to recession, bottoming out and coming back. Usually when longer-term interest rates are coming down. You also would want to see the Fed, cutting rates. That's not the environment we're in now. I don't think that environment probably will happen until late this year or beginning of next year. But I do think once small caps start to move, they're going to move quick. So I think you need to be invested in them now before you miss that movement.
I love hearing that because I was the lone crazy man about 6 months ago banging the table on small caps. But that's it. When you're contrarian, you want everyone else to start coming to your side. So glad to have company on this.
David, given the backdrop, the environment there, what sectors do I want to be overweight here?
Well, first of all, communications still the most undervalued sector according to our numbers, trades at a 13% discount. Now, a lot of that is going to be Alphabet. Alphabet, of course, based on its market capitalization, does skew the price to fair value for that entire sector. Alphabet's a 4-star rated stock at a 19% discount. We think the market is just overly concerned about the DOJ lawsuits and the threat of AI and the potential for breaking it up. In fact, our analyst has done a sum of the parts analysis. He thinks that stock is worth at least as much as where it's trading now, even if they were to be forced to split up. Having said that, I mean, the company's really still just hitting on all cylinders. If you look at the numbers, search, cloud, YouTube, all doing very well. If you take a look at the Mag 7, that's the only one that we still think is undervalued today.
Another name on your radar, David, Verizon. Walk us through that one.
Mm-hmm. Yeah, Verizon is a name we've actually been very constructive on for quite a while. About a year and a half ago, our analyst team started noting that they thought that the wireless industry would start acting more like an oligopoly over time, that they would compete less on price and start competing more on other kind of non-pricing items, and that would allow them to start raising their margins. We have seen that. It's a 4-star rated stock at a 20% discount, provides a really healthy dividend yield of 6.3%. And when I look at our model, the forecasts I think are pretty modest. We're only looking for like 2% top line growth, looking for only 6% earnings growth, over the long term. But the company's only trading at a 9x forward PE. We're seeing some good free cash flow expansion there. So I think that one's very attractive still.
What about Tesla, David?
Yeah, unfortunately, Tesla we still think is overvalued at this point. It's a 2-star rated stock, trades at a 26% premium to our fair value. Just taking a look at the deliveries in the first half of the year, I think those were disappointing. Our analysts think that really indicates that the product lineup is really kind of saturated the EV market at this point. I think the key for Tesla is going to be their affordable vehicle launch. That's not going to be at this point until later this year. And just to put that into context, we assume that Tesla is going to be able to ramp up to 1 million vehicles annually sold by 2028. That's going to be at least a third of the total vehicles by then. So really, that is the key for the next couple of years. Other than that, we do think there is some long-term upside from robo-taxis, but again, that's probably not going to launch for a few more years. So that's not necessarily a short-term catalyst.